forget the complicated jargon. Forget those spreadsheets that just make your eyes water. What if you could really get a handle on how much money a rental property could, actually put in your pocket? Not just the wishful thinking, but the real potential profit, stripping away all that mystery.
Yeah, that's exactly what we're diving into today.
We are.
And we're using a whole stack of insights, stuff you listeners have shared, market reports, investor forums, some really detailed financial guides. Our mission here really is to unpack all those numbers, look at the trends, and maybe expose some of those hidden factors that, determine true profitability.
Right.
This whole deep dive is about giving you that clarity so you can evaluate opportunities with, well, confidence.
Okay, let's jump right in then. When we talk about buying rental property, profitability, it sounds straightforward, but it's not quite, is it? There's some nuance there.
Oh, absolutely. Yeah. At its heart, profitability in real estate, it's just measuring the economic performance of that particular asset. It's not just, hey, I own a building. It's about how much money are you actually generating from renting it out, compared to what you invested and what it costs to keep it running.
Right. It's like the engine's output versus, the fuel and the maintenance needed. I saw one source mentioned an average rental yield somewhere in Spain, maybe 4% to 7%, which gives a sort of a very rough global benchmark maybe. But the key thing is U.S. numbers, they're going to swing wildly. Depends on the state, the city, even the street corner.
Oh, totally.
But the principle, the idea of measuring yield, that's universal.
Exactly. And to really measure that performance, there are basically two main ways we calculate profitability. The first one is what we call gross profitability.
Okay, gross profitability. Let's unpack that. That's the simple one. The top line number before things get messy.
That's it. Precisely. Gross profitability, it gives you that quick, often, let's be honest, optimistic snapshot. It's the yield before you factor in any of the property's running costs. Just gives you a rough idea based only on the potential rent versus what you paid for it.
So the formula is pretty simple then. Annual rent you think you'll get, divide that by the purchase price, times 100 for the percentage.
That's it. Yeah. One of our sources had an example that used euros, but the math's the same. Annual rent of, say, 14,388, purchase price 200,000. So 14,388 euro another 100. That gives a gross yield of 7.19%.
Okay.
Now, euros, specific numbers, but the principle is identical with dollars in the U.S. or anywhere. It's just your potential rent compared to the cost to buy the place.
Got it. So 7.19% looks pretty decent on the surface. But anyone who's owned property knows homes cost money. A lot more than just the purchase price.
They absolutely do. And that's exactly where the second calculation, net profitability, becomes, well, essential. This is the number that tells you the real economic performance, the realistic return on your money. It shows your income after you've carefully deducted all those associated costs.
Right. This is where it gets really interesting and maybe a bit sobering sometimes because expenses can really eat into that gross number, can't they?
They certainly can. The formula for net profitability is brackets, annual income, total annual expenses, close brackets, then divide by the purchase price and times 100. So using that same euro example, if the total annual expenses were, say, 9,000 euro, the calculation changes quite a bit. It becomes 14,388 euro, 900 euros, 200,000. You're 200,000. So that's 12,488 in net income divided by the 200,000 price times 100. The net profitability drops down to 6.24%.
Wow. So just 1,900 in annual costs knocked almost a full percentage point off the yield. That's substantial.
It is. And the key takeaway here isn't just expenses exist, it's how quickly they shrink that gross yield that looked so good at first glance, focusing only on that top-line gross number. That's probably one of the fastest ways investors get into trouble, maybe end up with negative cash flow because they just didn't budget accurately for how things really work. Net profitability, that's your non-negotiable starting point for a realistic look.
Okay. So let's move beyond percentages for a moment to something maybe even more tangible day to day or month to month. Cash flow. This seems like a really fundamental measure for any property investor. What is cash flow, just in simple terms?
Yeah, cash flow is basically the actual money moving. Is it coming into your pocket or going out on a regular basis because of that property? It's the difference between the income the property brings in and the cost to operate it and finance it. Are you making money each month or are you feeding the property money? It's like the property's financial heartbeat.
Okay. And one of our sources, Belong, they laid out a really clear sort of 4-step way to analyze cash flow accurately. Step 1, figure out the gross income.
Right. And the most obvious income source is, well, rent from your tenants. But as an investor, you really should think about all the potential income. Could you maybe charge extra for furniture? Is there a garage or a storage shed you could rent out separately? Any other services maybe? You add all that up to get your potential gross rental income.
And this feels like the big but. The absolutely crucial factor here is vacancy, right?
Oh, precisely. Yeah. Painful sometimes. Income just stops cold when the property's empty. So a place renting for, say, $2,000 a month looks like $24,000 a year on paper before vacancy.
Right.
Maybe a higher rent, $3,000 a month, looks like $36,000 annually. But if that $3,000 a month place sits empty for just 1 month,
Coof.
your annual gross income drops by $3,000 instantly. 2 months empty. That's $6,000 gone from your expected income.
Wow. Yeah, just 1 month vacancy takes a huge bite out of that annual figure. It really underscores why minimizing vacancy and budgeting for it is so critical.
It absolutely does. So while the simple math looks like rent plus other income, the realistic calculation for your projected gross rental income has to factor in some kind of estimated vacancy rate. You basically subtract the potential income lost during those empty periods from your total potential income. That gives you a much more grounded annual figure to work with.
Okay, so that's step 1, calculate realistic income, factoring in vacancy and maybe other bits of revenue. Step 2 is where we figure out the gross operating expenses. And based on our sources, this list is, well, it's longer than many first-timers might think.
It certainly is. And capturing all these costs accurately is just fundamental if you want to avoid nasty surprises later. Our Baselane source, especially their landlord survey, had some great insights here. They found a staggering 82% of landlords saw their ownership costs go up in 2024.
82%.
Yeah, and for 26% of them, so over a quarter, those costs jumped by more than 20%.
Whoa, over 20%. That's massive.
Yeah.
What was driving that mainly?
Well, the most common culprit, mentioned by 60% of landlords, was property taxes.
Oh, right.
Which makes sense, right? Property values have been rising fast in many areas, assessments go up, and boom, your tax bill jumps. Kind of a double-edged sword for owners.
Yeah, you like the appreciation, but hate the tax bill that comes with it.
Exactly. Then there's maintenance and repairs, huge category,
Yeah.
mentioned by 57% of landlords. Our sources noted, citing some Thumbtack data in that Baselane report, that average maintenance for a single-family home can easily top $10,000 a year.
10 grand
Yeah.
just for maintenance.
Yeah, and that's not just, the roof caving in, it's everything. Leaky
Yeah.
faucets, toilets that keep running, fixing appliances, but also the regular stuff, lawn care, gutter cleaning, maybe snow removal, depending where you are. It all adds up.
Okay, so budget big for repairs, both the unexpected and the predictable stuff. What else is on this list?
Utilities are another big one, cited by 49% of landlords. Things like electricity, water, gas, internet, maybe cable, security systems, trash pickup. Now, whether the landlord or tenant pays these can vary,
Right.
but if you're covering them, it's a direct hit to your cash flow. And these costs vary wildly, based on region, property size, age, how energy efficient it is.
And insurance. Can't forget insurance.
Nope. Insurance premiums, mentioned by 43%. You absolutely need a specific landlord policy. It's different from regular homeowners insurance.
Hope so.
It's usually more comprehensive, covers the building, sure, maybe any furnishings you provide, but also crucial liability protection. And really important, loss of income coverage if, say, a fire makes the place uninhabitable for a while.
Oh, okay. That makes sense.
And you might also need mortgage insurance, depending on your loan.
What about the costs if you hire someone to manage the property instead of doing it all yourself?
Good question. Property management fees are very common. Typically, they run somewhere between, say, 6% to 10% of the gross monthly rent. Now, if you decide to self-manage, you avoid that fee, right? But then you have what you could call DIY costs.
Meaning your time, basically.
Your time, which definitely has value, but also direct expenses like marketing the place, maybe getting professional photos for listings, legal fees if you need help with the lease, possibly travel costs if you have to go there for inspections or showings, background check fees for screening tenants.
So, yeah, self-managing isn't exactly free. It just shifts where the cost shows up, time and direct expenses.
Precisely. And circling back to vacancy for a second, step 1 looked at the lost income during vacancy. But there are also operational costs associated with vacancy itself.
Ah, okay. So even when no rent's coming in.
You still have bills, utility bills, even minimums, property taxes, insurance, maybe marketing costs to find a new tenant. They don't stop just because the place is empty.
Ouch. So vacancy hits you twice, no income, plus continued expenses.
Exactly right. Other potential costs. Well, homeowners association, HOA fees, if it's in a community with one. And critically, you must budget and save for capital expenditures. CapEx. Right. Those are the really big ticket items, the ones that don't happen often but cost a fortune.
Yes. Think major improvements or replacements, things that either significantly boost the property's value or, extend its life and prevent huge, unexpected repair bills later, like a new roof, replacing the whole HVAC system, major plumbing or electrical work, building a new deck.
Okay. And those aren't immediately tax-deductible like fixing a leaky faucet, are they?
Correct. They're generally capitalized, meaning you add their cost to your property's basis, but you can recover that cost over time through depreciation, which we'll get to, or offset it against capital gains when you sell. The key insight here, though, is budgeting. A property might look cash flow positive month to month, but if you're not putting money aside regularly for future CapEx...
One big repair can wipe out years of profit. Exactly. Budgeting maybe 10%, 15% of the gross rent just for CapEx reserves is a pretty common rule of thumb.
That makes total sense.
Yeah.
It's not just planning for the leaky faucet this month, but planning for the new roof in 10 years.
Right. You also have to think about professional services, budgeting for an accountant, to handle the books and taxes for the property. Wise move. One source suggested maybe budgeting $500 a year just for potential legal help, reviewing a lease, maybe dealing with an eviction, navigating local rules, tenant screening fees, or maybe broker fees if you use someone to find tenants. Those can range from a few $100 up to a full month's rent. Though thankfully, there are more affordable, even free online screening tools now.
What about the costs just to get the place ready, or the business side of things?
Good points. Yeah, there can be upfront one-time costs that hit your initial investment but should be part of the overall picture. Things like business registration fees, maybe local licenses. Those are often tax-deductible later. Home inspection fees before you buy, pretty essential sometimes. Appraisal fees, and if you're managing it yourself and it's not right next door, travel costs. Driving back and forth for inspections, showings, fixing things, gotta track that.
Right.
And just basic office expenses, supplies, maybe software for accounting or management, phone, postage. If you're running it like a real business, those are real costs.
Okay, wow. So step 2 is basically compiling this potentially very long list and budgeting for all of it. Taxes, maintenance, utilities, insurance management, vacancy costs, HOA, CapEx savings, professional help, one-time costs, business costs. Phew. That feels like the point where the rosy picture of rental income meets cold, hard reality.
It often is, yeah. Missing or just under budgeting any of these can kill your profitability. But once you have your realistic gross rental income from step 1 and your total gross operating expenses from step 2, you move to step 3. Calculate your net operating income, NOI.
And NOI is just income minus expenses, step 1 minus step 2.
Exactly. Simple as that. NOI is gross rental income, gross operating expenses. Using that belong example again, if your annual gross income was $36,000 and your total annual operating expenses were $4,000, your NOI would be $32,000 a year. That number, NOI, it represents the property's ability to generate income just from its operations before you consider how you paid for it.
Okay, $32,000 NOI. And if, hypothetically, you bought the place with all cash, no mortgage.
Then your NOI is your cash flow. That's it. That's the profit from operating the property itself.
But most investors use financing, right? There's usually a mortgage. So step 4 is accounting for debts or financial liabilities.
Correct. This is where the cost of borrowing, your leverage, comes into the picture. For most people, the main liability is the mortgage payment principal and interest. You subtract your total annual debt service, that's all your loan payments for the year related to that property, you subtract that from your NOI.
And that final difference, that's your cash flow number, which could be positive or negative.
Precisely. So using the belong example, NOI was $32,000. If the annual mortgage payments were $18,000, which is $1,500 a month, your annual positive cash flow would be $14,000. $32,000 minus $18,000. Divide that by 12, and you're looking at about $11,166 coming into your pocket each month after paying all the operating costs and the mortgage.
That's the dream for a lot of investors, isn't it? Positive cash flow, passive income.
It is. But the source also made a good point about how sensitive that number is to changes in financing costs, especially with variable interest rates or maybe refinancing.
Well,
what if that same property's mortgage payment went up, say, to $1,696 a month because rates changed? Now your annual debt service jumps to $20,352.
And suddenly, that $14,000 annual cash flow drops. let's see, $32,000 minus $20,352, down to $11,648, which is only about $970 a month.
It's a big difference. It really shows how rising interest rates or just different loan terms directly hit your cash flow, even if your rent and operating costs haven't changed at all. So this whole analysis tells you if you have positive cash flow income is greater than costs, money coming in each month helps build stability, covers surprises, or negative cash flow.
Negative cash flow, also called negative gearing sometimes. That sounds bad, like you're losing money every month.
Oh.
Is that ever like a deliberate strategy?
It can be, yeah. Though it's definitely riskier. Negative gearing just means your total cost operating expenses plus your debt service are more than your rental income, so you have a loss each month or year. Some investors, they choose this. They accept that monthly loss because they're betting heavily on the property appreciating significantly over the long term.
Ah, okay. So they're sacrificing cash flow now, hoping for a big payout from capital gains later when they sell.
Exactly. And there are tax implications, too. Those operating losses plus depreciation deductions we'll talk about can potentially offset other income, which lowers their overall tax bill. But let's be really clear. This isn't just accidentally losing money. It's a conscious choice. It means you need extra cash every month just to cover the shortfall. It's higher risk, depends heavily on the market going up, which, is never guaranteed.
Right. Okay, so cash flow is absolutely critical. It's the property's ongoing financial pulse, money in, money out. But our sources show it's just one piece of the puzzle. There are other metrics that give different perspectives, especially maybe when you're comparing different potential investments before you buy.
Right, yeah. One really key metric, especially common in commercial real estate, but also useful for comparing similar residential rentals, is the capitalization rate, or cap rate.
The cap rate, okay, what does that tell an investor? What's it for?
Think of it like an estimate of the rate of return the property generates if you bought it with all cash, no debt involved. It basically shows the property's intrinsic, unlevered rate of return over 1 year, just based on its operating income relative to its current value. It's super useful for comparing the relative value and income potential of different properties because it strips out the effect of how each individual might finance their purchase.
Okay, so it lets you compare apples to apples on the property's operational performance, regardless of mortgages.
Precisely, yeah. It can also give you a sort of rough idea of how long it might take to get your initial investment back just through the property's net income. Like a 10% cap rate suggests theoretically it would take about 10 years of the current NOI to equal the property's value, assuming big assumption that NOI stays the same.
Gotcha. And the formula is net operating income, NOI, divided by the property's current market value.
Yes, and that current market value part is important. Our Investopedia source really stress using the current value, not what you paid for it years ago.
Why is that?
Because using the original price on a property bought, say, 20 years ago, it's just not realistic. Or maybe you inherited it. You don't even have a purchase price. Using the current market value gives you an accurate picture of the yield today relative to what it's worth now.
Makes sense. But like gross profitability, cap rate isn't the whole story either, right? It has limitations.
Definitely not, yeah. Biggest limitation, it completely ignores leverage, doesn't account for your mortgage at all. It also doesn't factor in the time value of money or potential future cash flows you might get from, say, renovating and raising rents or market changes down the line. It's less reliable for properties with really irregular income, like maybe short-term rentals. And it doesn't account for depreciation or big shifts in the market.
So it's like a snapshot, a single moment in time.
Yeah.
Not really a projection of the whole investment in life. What kinds of things affect a property's cap rate?
Oh, lots of things. Location is huge. A property in a super desirable low-risk area, maybe a downtown core, it'll almost always have a lower cap rate than a similar place in a less central, maybe higher-risk area.
Even if the downtown place makes more rent?
Yeah, because its market value is likely much higher relative to its income. So the ratio, NOI divided by value, is lower. Other things, competition in the area, local economic growth, any improvements you make that boost the NOI, like renovations that let you charge more rent. And interestingly, cap rates generally tend to go up when interest rates go up.
Really? Why is that?
Well, think about it. If it costs more to borrow money, investors generally demand a higher return from the property itself relative to its value to make it attractive compared to other, maybe safer investments.
Okay, that makes sense. So is there like a universally good cap rate number to aim for?
Not really, no. There's no single magic number. It totally depends on your own tolerance for risk and the specific market you're looking at. Investopedia suggested, generally maybe 5% to 10% is often seen as good, but that varies hugely. A lower cap rate, maybe 4% or less, might mean lower perceived risk, but maybe a longer payback period based just on income. A higher cap rate, say over 10%, often signals higher potential risk, but maybe a faster return based on income alone. Think about that city center versus outskirts example again. City center might have a lower cap, seen as lower risk due to demand. Outskirts might have a higher cap, higher potential return on paper, but more uncertainty.
The Investopedia source had some good examples with a hypothetical investor, John. If John buys a $1 million property and it generates $70,000 in NOI.
That's a 7% cap rate? $70,000. And compared to something relatively safe, like maybe a 3% treasury bond, that extra 4% is John's reward for taking on the risks of earning real estate.
Right. But if that same $1 million property only made $20,000 in NOI, maybe because of high vacancy or big repairs,
the cap rate plummets to 2%, $20,000. Suddenly, it's earning less than that risk-free bond. That really highlights poor performance and risk. Or if NOI was $40,000 due to higher expenses, that's a 4% cap rate. Better, but still maybe not great compared to the 7% scenario.
And what if the property value dropped, say, to $800,000, but the NOI stayed at $70,000?
Then the cap rate jumps up to 8.75%, $70,000, $800,000. This whole set of examples really shows how changes in income, expenses, and property value all directly impact that cap rate. And it points to all the risks involved: property age, location, property type, single family versus multi, tenant reliability, lease terms, the overall market, even bigger economic factors.
Those are really powerful examples. And Investopedia specifically said cap rate is different from ROI because cap rate assumes that all cash purchase, right, while ROI brings financing into it.
Exactly. Which leads us nicely to the next key metric, return on investment, or ROI. How do we calculate that for a rental property, and how is it different?
Yeah, what goes into ROI?
ROI measures the return based specifically on the actual cash you, the investor, put into the deal. It does factor in leverage if you used a mortgage. The Reddit source had a pretty clear formula: yearly net profit divided by your total cash invested.
Okay, so cash invested here isn't the full purchase price if I got a loan.
Correct. This is the money that came straight out of your bank account to get the deal done and the property ready. Typically, that's your down payment, all your closing costs for the purchase and the loan, and any money you spend on initial repairs or rehab work needed before you could rent it out.
Got it. Your actual out-of-pocket investment and yearly net profit for ROI. Is that just the cash flow number we calculated earlier?
It's actually a bit more than just the cash flow. It includes your annual cash flow, the money left after income, operating expenses, and the mortgage payment, plus the part of your mortgage payment that went towards paying down the principal balance.
Oh, okay. Because paying down the loan principal builds your equity, right? It's a return, even if you don't see it as cash until you sell or refi.
Exactly. You get a return from the monthly cash flow and from the equity being built as the tenant's rent pays down your debt. That Reddit example was good here. An investor put in $80,000 cash total, $50 down, $10 closing, $20K for initial repairs.
Okay.
Their monthly net profit was calculated at $800.
Right. And they break that $800 down. How?
They said it was $300 in positive cash flow that month, plus $500 that went towards paying down mortgage principal that month. So that $800 a month adds up to $9,600 a year in total net profit, $300 cash plus $500 principal, 12 months.
Okay, so the ROI calculation is $9,600 yearly net profit divided by $80,000.
Yeah.
Total cash invested. Carry the one. That's 12%, which sounds pretty solid based on the actual cash put in.
It is, yeah. And the Reddit thread also mentioned that investors often look at ROI in kind of two ways. First is that strict cash flow ROI, just your cash flow divided by cash invested. That's very black and white, based only on the money coming in and out right now.
And the second way includes?
The second is often called total return ROI. That includes cash flow plus principal paydown plus potential appreciation.
Appreciation. The crystal ball part.
Exactly. You estimate how much the property value might have increased over the year, add that to your cash flow and principal paydown, then divide by your cash invested.
And the source, and just common sense really, stressed how risky and uncertain projecting appreciation is.
Absolutely. Trying to predict future property values, especially in markets that are changing fast or seem uncertain, is really difficult, very speculative. I mean, maybe someone planning to hold for 15 years can make a more conservative guess than a short-term flipper, but relying too heavily on uncertain future appreciation in your main ROI calculation can be pretty misleading.
Right.
Cash flow and principal paydown, those are concrete, happening now. Appreciation, that's a projection, a hope.
Okay. One last metric, rental yield. Our ADL source used this one when they were ranking cities for investors.
Yeah.
How's it different from cap rate or ROI?
Yeah, rental yield is kind of similar to gross profitability and, in a way, cap rate. It compares the property's income as a percentage of its market value. But it's often used more broadly, maybe in market analysis reports or those best cities lists like the ABL one. The formula is usually simplified, just annual rent divided by property value.
So gross income relative to value, no expenses taken out, no leverage considered.
Correct. It's a simpler, high-level metric, mostly used just to quickly compare the income potential of different properties or markets relative to their cost or value. A higher yield generally suggests a property is generating more gross income for its price, which could mean higher profitability. But, you still need to drill down into the expenses and financing to get the real story. It's like a quick filter.
Got it. A starting point for comparison. Okay, so we've really broken down the core calculations: gross profitability, net profitability, the detailed steps for cash flow, and these other key metrics like cap rate, ROI, and rental yield. Now let's zoom out a bit, because profitability isn't just about the numbers on your spreadsheet, right? It's massively influenced by the market you're actually in.
Oh, hugely.
Our Baselane source had a ton of detail on the current U.S. rental market trends. What are the big takeaways there?
Yeah, it did. And the really big insight from that data, landlords today are feeling squeezed. On one hand, 85% of landlords said they raised rents in 2024. A big chunk, 31%, raised them by 6-10%. And 78% plan more increases in 2025, averaging around 6.2%.
Okay, so rents are going up.
But they're largely doing this just to try and keep up with soaring operational costs.
Right. That Baselane survey found 82% of landlords saw their ownership costs increase in 2024. And for a quarter of them, costs jumped over 20%.
Exactly. And the main things pushing those costs up, according to the survey: property taxes, 60% cited that, maintenance, 57%, utilities, 49%, and insurance, 43%. And it's not just general inflation, it's specific things. Rising property assessments, higher costs for building materials and labor, think supply chains and shortages, volatile energy prices, even higher insurance risks maybe due to climate events in some areas.
Wow.
So landlords are kind of being forced to pass some of those higher operating costs on to tenants just to try and maintain the same level of profit they had before. It's a tough spot.
Another really critical trend is that whole supply and demand picture in the rental market. The national vacancy rate ticked up just a tiny bit, right? Q3 24 versus Q4 2023.
Yeah, from 6.6% up to 6.9%. A slight rise in empty units nationally, but despite that, the national median rent for a two-bedroom still went up 3.2% year over year in Q4 2024.
So more empty units, but rents are still rising nationally. What does that tell us?
It tells us that on a national level, even though new construction is adding supply, it hasn't yet significantly outpaced the underlying demand enough to cause rents to drop across the board.
But real estate is all local, right?
Yeah.
National numbers can hide a lot.
Absolutely. That's the real insight here. You've got places, maybe parts of the Northeast or Midwest, where supply is still really tight, maybe construction is difficult, rents stay high there. Think New York, Detroit, according to some reports. But then you look at parts of the Sun Belt or the Intermountain West, places like Phoenix, Austin, where there's been a lot of new single-family construction.
Mm-hmm.
In those specific markets, that increased supply is sometimes meeting or even slightly exceeding demand. And what happens? Rent growth slows down, maybe even dips slightly, or landlords have to offer deals like a month free or paying for utilities just to get tenants.
So more competition in those high supply areas means investors there need to be smarter, maybe offer better amenities, while low supply areas have pricing power but maybe higher buy-in costs.
Exactly right. And a really major ongoing trend the sources highlighted is the huge and growing demand for single-family rentals, SFRs.
Yeah, that seems driven by people wanting more space, yards, maybe a home office.
Yeah.
Especially after the pandemic.
It's a massive shift. Apparently, 31% of renters now live in single-family homes. That's 3.5 million more renters in those homes compared to 20 years ago. And that's strong demand. It means strong rent growth for SFRs. They were up 4.4% year over year in Q4 2024.
So investors are noticing this trend.
Oh, yeah. The Baselane survey found 71% are optimistic about rental property profits in 2025, especially those focused on SFRs. 33% were very optimistic. And get this, 32% of landlords surveyed plan to buy 2 to 3 more properties this year, and 67% mostly own single-family rentals.
And the actual purchase data backs this up. Investors buying more SFRs.
It does. Purchases of SFRs by investors had their biggest year-over-year jump in 2 years, back in Q2 2024, up 6.7%. Meanwhile, purchases of multifamily, condos, townhouses, those actually went down.
Yeah.
The market seems to be saying SFRs offer good long-term value and stability right now.
Technology is also changing the game for property management, isn't it?
Oh, big time. Yeah. The sources show a huge move towards tech. 93% of property managers said they adopted some new tech in the last 18 months. Everything from using social media for marketing to setting up online portals for tenants to pay rent or request repairs. AI is even getting involved, automating responses to inquiries, scheduling tours, managing communication.
That sounds like it could seriously cut down on those DIY costs for landlords managing things themselves. Save a lot of time.
It absolutely can. Save time, potentially save money on tasks that used to need a person. Tech is also huge for rent collection now. Almost half of landlords surveyed use P2P apps like Venmo or Zelle. Another 27% use dedicated property management platforms. Though interestingly, paper checks are still used by 56%. A bit surprising.
Yeah, a real mix of old and new still.
Right. And even with all the benefits, there's a big hurdle. Cost. 35% of landlords in that survey said the cost of new tech was their biggest barrier. So there's definitely a need for more affordable, easy-to-use solutions, especially for smaller, independent landlords. Some free platforms were mentioned as trying to fill that gap.
Okay, let's shift gears a bit. Regulations. The source suggests tenant protection laws are on the rise. That must have a big impact on how landlords operate and calculate potential profit.
Oh, it's a major factor, definitely gaining momentum across the country.
Yeah.
Mostly driven by the affordable housing crisis, right? As of 2024, at least 7 states, plus tons of cities and counties, have some form of rent control or stricter tenant laws. California was mentioned, capping increases at 5% plus inflation. Oregon, 7% plus inflation.
So that directly limits how much rent can go up, even if the market or costs would justify more.
It does. And 17% of landlords in the survey said just keeping up with and complying with these complex, constantly changing local rules is a significant challenge. These laws, sometimes made worse by zoning rules that favor single-family homes over denser housing, they're meant to help tenants, but they can have, well, side effects.
Like maybe discouraging people from investing in rental housing.
Yeah.
Or putting less money into upkeep.
Exactly. From the landlord's view, the challenges are obvious. Less freedom to set rents, potentially lower profits because of those caps, combined with the rising costs we talked about, plus just higher operating costs and hassle, dealing with legal advice to navigate the rules, potential disputes. It's a balancing act. Weighing the cost of compliance versus the risk of tenant turnover or legal fights, it's a really complex, ongoing debate.
So understanding the specific rules in your city or state is just as crucial as getting the income and expense numbers right.
Absolutely critical. And speaking of location, our ABL source really hammered home how much profitability varies place by place. They ranked cities based on key investor metrics.
Right. They looked at things like median rental yield, population growth, home appreciation, rent growth, percentage of renters, vacancy rate, all things that feed into profitability.
Exactly. And the cities at the top of their list really show the diversity out there. Charleston, South Carolina had the highest median rental yield, 6.78%. Atlanta was close behind at 6.58%. Dallas at 6.13%. Cincinnati, D.C., Boston also had yields over 5.9%. So potentially strong income relative to property value in those places.
And population growth. Dallas was huge, adding over 150,000 people. Atlanta added almost 70,000. More people usually means more renters. Orlando, Charlotte also saw big growth.
But rent growth, that was all over the map, really shows those local supply-demand forces at work. Tulsa, Richmond, Indianapolis had strong rent growth, like 6-7%. But some big cities on that list actually saw negative rent growth year over year. Atlanta down 8.1%, Charlotte down 8.1%, Orlando down 2.7%, D.C. down 2.6%.
Wow, negative rent growth in major cities that are still growing. How does that happen?
It could mean that new construction, that new supply is finally catching up or even getting slightly ahead of demand in those specific markets, leads to more competition, landlords maybe have to lower rents or offer deals. Or it could be other local factors, shifts in renter preferences, economic changes. It means investors there really have to adjust, focus on keeping costs low, maybe offer concessions.
Vacancy rates also tell part of that supply-demand story. Low vacancy is generally good for landlords, right? Fewer empty units.
Yes. Low vacancy means strong demand compared to supply. Boston had a remarkably low 2.5% vacancy rate on that list. Fresno, Seattle, Knoxville also very low, around 3-4%. That suggests tenants have fewer choices, gives landlords more pricing power, less risk of lost income.
Wait, some cities with high yield, like Charleston, or high population growth, like Dallas, had pretty high vacancy rates. Charleston was 12%, Dallas over 8%. How does that work?
That's the complexity, right? That's the key insight. High yield in Charleston might be true for the units that are rented, but that high vacancy suggests there are also a lot of empty units. maybe overbuilding in some areas. Maybe it's very seasonal because it's a tourist spot. High population growth in Dallas is happening, but maybe the new construction is outpacing even that growth right now. Or maybe the new people aren't looking for the types of rentals being tracked. Or maybe vacancy is high in some suburbs but low downtown. You can't just look at one number. You've had to see how yield, growth, and vacancy all interact and know the local specifics.
The source also mentioned something interesting about smaller tertiary markets seeing huge rent growth.
Yeah, that's another fascinating trend. Places like Oxford, Mississippi, Athens, Ohio, Mount Pleasant, Michigan, they saw rent growth of like 25%, 21%, 17%. Huge numbers. It suggests that as costs keep rising in the big cities, renters are looking further out, moving to smaller towns, and that's driving up demand and rents there.
So those smaller markets could be interesting opportunities for income, maybe, but state laws might differ there too.
Exactly. States with tougher tenant laws, like California or New York, tend to have slower rent growth and more compliance costs. Many of those high-growth, smaller markets are in southern or Midwestern states that might have fewer regulations. That regulatory environment is a huge piece of the puzzle when you're evaluating long-term profit potential anywhere.
Looking ahead then, based on all these trends, what are the projections for the rental market?
Well, the Baselane source expects shifting demographics to keep shaping things. Millennials, Gen Z, they're a huge part of the renter pool. They want flexibility, good internet is non-negotiable, smart home features are increasingly expected, easy digital payments. If you're renting in a community, shared amenities like co-working spaces are becoming popular. Landlords who adapt their properties will do better.
Sustainability is also becoming a bigger deal for renters and maybe for costs.
Yes, definitely. Growing demand for energy efficiency, solar panels, efficient appliances, good insulation. Renters might pay a bit more for lower utility bills and greener features. Plus, there are often incentives like tax credits for landlords who make these upgrades.
What about financing? Any good news there, potentially?
There's some hope, maybe, for mortgage rates easing a bit for investors in 2025. If that happens, it could spur more investment, maybe help ease inventory shortages in some places by making it easier to buy and develop.
And overall competition in the market?
Yeah.
Still tough.
Likely, yes. High interest rates, high home prices. That keeps pushing people towards renting, which is good for rental demand. But it also means landlords face those challenges. Rising costs, more regulations, lots of competition from other investors. The key takeaway for the future, according to these sources, get to leverage technology to be efficient, cut costs, save time, manage expenses like a hawk, and stay really informed about what's happening in your market and with regulations.
Okay, so market forces are incredibly powerful, constantly shifting, affecting every single number in our cash flow math, influencing cap rates, yields. But beyond just reacting to the market, our sources also said there are strategic things you as an investor can do to actively boost profitability, to improve those calculations.
Oh, absolutely, yeah. The Muppy source laid out several key strategies. First, and maybe most impactful right at the start, negotiate that purchase price.
Make your money when you buy.
That's the idea. If you can acquire a property below its real market value or maybe below its potential value after some fixes, that gives you a huge head start on your return, immediately improves your ROI calc because your cash invested is lower, requires good research, good negotiation.
Okay, well.
Second, optimizing the rental price. Finding that sweet spot, high enough for good income, covers your costs, but not so high it scares off good tenants and leaves you vacant for months, which is costly. Needs market knowledge.
Third, choosing the right rental model.
Yes, critical strategic choice. Are you doing traditional long-term leases, maybe 12 months? Or temporary rentals? Or diving into short-term tourist rentals like Airbnb? Or maybe even renting by the room. Each one has totally different results for income potential, expenses, how much work it takes, and rules you have to follow.
That Deal Machine source talked specifically about short-term versus long-term rentals, didn't they?
They did. Short-term rentals, yeah, especially in tourist hotspots. Nashville was mentioned. They can potentially bring in much higher gross income per night or per month. You can charge more during peak times, adjust prices.
But there's always a but. Higher income usually means higher costs and more hassle, right?
Substantially higher, yeah. Short term means constant turnover. So way more cleaning costs, more wear and tear on the place, more empty days between guests, or for cleaning when you're not earning income. The management effort is intense. It's basically running a small hotel. And the regulatory risk is growing fast. Lots of cities are cracking down with strict rules, even bans on short-term rentals.
Okay, so potential for higher gross revenue, but definitely higher costs, much more work, and growing regulatory headaches. Long-term rentals, by contrast.
Generally offer much more predictable income. Usually lower operating costs, tenants might pay utilities, less frequent maintenance per tenant, way less management but once you find a good tenant, and fewer regulatory hurdles compared to that fast-changing short-term world. The key is picking the model that fits your goals, your capacity to manage it, your stomach for risk, and importantly, what's actually allowed and makes sense in your specific location.
Fourth strategy, selecting tenants. This isn't just passive, is it?
Not at all. Tenant selection is absolutely fundamental to staying profitable. Finding tenants who can reliably pay the rent on time, who are responsible, who take decent care of the place, that minimizes late fees, avoids expensive evictions, cuts down on repair bills, and keeps your property in good shape. Thorough screening is key.
And fifth, just actively managing expenses. This goes right back to our cash flow calculation.
Yep. Skillfully managing that whole list of operating costs directly boosts your NOI, which boosts your cash flow and profit. It means actively looking for ways to save. Can you get better insurance rates? Find reliable but cost-effective repair people. Install energy-saving things to cut utility bills you pay. Maybe working with specialists, like a good property manager or accountant, can uncover savings to bulk discounts, smarter ways to handle things.
So these strategies, negotiation, pricing, model choice, tenants, expense control, these are the levers you can actually pull to directly improve the numbers in your calculations.
Absolutely. They give you some control. And then beyond those operational things, there are some significant tax advantages to owning rental property in the U.S. These can dramatically change your after-tax profit and return, sometimes making a modest pre-tax return look much better. Our Symphona source covered these well.
Ah, yes, taxes, where understanding the rules can literally put money back in your pocket.
It really can. One really powerful tool is the Section 131 exchange, sometimes called a like-kind exchange. This lets you defer paying capital gains taxes when you sell one investment property if you use the proceeds to buy another like-kind property. You have to follow very strict rules and timelines.
Defer taxes, so you don't pay them right away.
Right. It lets you reinvest the full amount from the sale, including the profit, into a new property. Instead of losing a chunk to taxes right then, you keep it all working for you, which can really accelerate growing your portfolio over time.
That sounds huge for building wealth over the long term.
It can be. On a more regular basis, you can take business tax deductions. For all those ordinary and necessary expenses related to owning and operating the rental property, most of those operating costs we listed. Property taxes, mostly. Insurance, maintenance, utilities you pay, management fees, advertising, legal fees, accounting, deductible. The key nuance is timing. Expenses you incur after the property is ready and available for rent in service are usually deductible that year. Costs from before that, like maybe initial renovations, often have to be capitalized, added to the property's cost basis, and depreciated over time.
Okay. And depreciation, that's the big tax break everyone talks about with real estate, isn't it?
It's probably the most significant one, yeah. Depreciation lets you deduct a portion of the property's cost each year as an expense on your tax return, even though no cash actually left your pocket for that depreciation. For residential rentals, the cost of the building itself, not the land, you have to separate the land value, is depreciated over 27.5 years. Commercial property is 39 years. This creates a paper loss that reduces your taxable income from the property.
So even if your cash flow is positive, your taxable income from the property could be lower, maybe even negative because of depreciation.
Exactly. That's where tax strategy really boosts your after-tax return. And sometimes certain parts of the building or specific improvements can actually be depreciated faster than that standard 27.5 years.
Faster depreciation.
Yeah.
That sounds good. How does that work? Is that where cost segregation comes in?
Yes, precisely. A cost segregation study is basically a detailed analysis of the property. It identifies components that are normally lumped into that long 27.5 or 39-year schedule and reclassifies them into shorter depreciation periods, maybe 5, 7, or 15 years. Think things like carpeting, certain fixtures, maybe landscaping, specialized plumbing, or electrical for equipment.
Okay, so it lets you take those deductions sooner.
Exactly. It accelerates your depreciation deductions, increases those paper losses in the early years, which reduces your current taxable income more quickly. Can be very powerful, especially on larger properties or ones with recent major renovations.
Pulls those tax benefits forward. Got it. The source also mentioned 3 safe harbors from the IRS, ways to deduct things more easily.
Right. These can simplify things for landlords. First, the de minimis safe harbor. This lets you deduct small dollar invoices for acquiring or producing property components right away instead of capitalizing and depreciating them. The limit is often around $2,500 per item or invoice, depends on if you have certain financial statements.
So buying a new dishwasher for under $2,500, maybe deducted immediately?
Potentially, yes, instead of depreciating it over many years. Helps with those smaller, routine replacements.
Okay. What's the second safe harbor?
The routine maintenance safe harbor. This lets you expense costs for repairs and maintenance that you expect to do periodically, maybe every 10 years or less, just to keep the property in good working order. Think routine painting, replacing worn-out carpet sections, fixing specific parts of the HVAC rather than the whole system. If it's truly routine upkeep, you can deduct it immediately.
So regular maintenance is deductible right away. Good.
Yeah.
And the third?
Third is the safe harbor for small taxpayers. If you qualify based on having relatively low average annual gross receipts and the building costing not too much, you can elect to deduct all your annual expenses for repairs, maintenance, and improvements on that building up to a certain limit.
All of them. Even improvements.
Yes, provided the total doesn't exceed the limit, which is the lesser of $10,000 or 2% of the building's original cost basis. It can really simplify bookkeeping for smaller landlords, letting them expense costs that might otherwise need capitalizing as long as they meet the criteria.
That sounds incredibly useful for simplifying taxes for smaller investors.
It can be, yeah. Definitely worth looking into. And finally, maybe the most significant tax concept for investors who have other income: passive income rules and qualifying as a real estate professional.
Okay, this sounds important.
It is. Normally, rental income and any losses from rental property are considered passive activity by the IRS. And generally, passive losses can only offset passive income. So if your rental property generates a tax loss, often because of depreciation, you usually can't use that loss to reduce your taxable income from your day job or from another active business unless you have other passive income to offset it against.
Okay, so passive losses are stuck offsetting only passive income. But there's a big exception.
Yes, a huge one. If you qualify as a real estate professional according to the IRS rules, and this isn't about just having a real estate license, it's based on meeting specific tests about how much time you spend involved in real estate trades or businesses during the year. Material participation is key.
And if you do qualify as a real estate professional, what changes?
Everything changes regarding losses. Your rental activities are generally considered non-passive.
And non-passive losses.
Non-passive losses can be used to offset your ordinary income, your salary from your job, income from an active business you run, portfolio income like interest and dividends.
Wow. So those paper losses from depreciation, maybe amplified by cost segregation, could directly reduce the taxes you owe on your salary.
Exactly. This is a massive benefit if you generate significant tax losses from your rentals. Qualifying as a real estate professional lets you use those losses to potentially slash your overall tax bill across all your income sources. It can dramatically boost your effective after-tax return on investment.
Okay. That sounds like a game changer for people heavily involved in real estate who also have other significant income.
It absolutely can be. Now, it's a complex area. The rules are strict. Documentation is key. You definitely need to talk to a qualified tax pro about it. But the potential benefits are enormous for serious investors.
Wow. Okay, we have covered a ton of ground today, from the basic math of gross and net profitability to that detailed step-by-step process for calculating real cash flow, getting the income right, tackling that long list of expenses, factoring in debt.
We also looked at those other useful metrics like cap rate and ROI. I talked about how all those market trends, rising costs, supply and demand shifts, SFR growth, tech, regulations, how they all ripple through your numbers.
And then we explored the strategies you can actually use: negotiation, pricing, rental models, tenant screening, expense control, plus those really powerful tax advantages that can significantly boost your bottom line.
Yeah.
The big takeaway, the theme running through all of this, it seems really clear. Calculating potential profit from a rental, it is so much more than just rent minus mortgage. It's this dynamic, multi-layered process.
It really is. It takes diligence. Understanding your real income potential, including vacancy, being brutally honest and thorough about all the expenses, the monthly bills, and the big future costs like CapEx, accurately accounting for your financing, staying sharp about market changes and local rules, and then actively using strategies and tax rules to your advantage.
The accuracy of your profit calculation seems directly tied to how much effort and detail you put into researching and managing all those moving parts. It's not a one-time calculation. It's ongoing management.
Much more complex, yeah. So as you, the listener, are looking at potential rentals, crunching these numbers, remember the calculations give you a vital map, right? But the actual journey of owning and running a rental property. That also involves market feel, constant management, and yeah, a certain tolerance for the unexpected things that just happen.
So the final thought for you to ponder, how will you balance that analytical precision you need for the calculations with the sometimes messy, always evolving reality of being a landlord, dealing with rising costs, changing rules, and unpredictable markets? Something to think about as you weigh your next steps.